It's 2 a.m. You're lying in bed, staring at the ceiling fan just slicing through the silence. You've got that heavy feeling in your chest. You check your phone, refresh the banking app, and you see the balance. It's there. It says you have X amount of dollars. You feel a momentary relief, and then the thought creeps in. What if I wake up tomorrow and that number is just gone? Or frozen? Or what if the bank just says, sorry, we're closed? It sounds paranoid, right? It sounds like something your crazy uncle who hoards gold coins and canned beans would say at Thanksgiving dinner. But honestly, if you've been paying attention to the news lately, or if you know anything about history, that paranoia starts to look a lot like common sense. We've seen it happen in modern times in other countries. We've even seen glimpses of it here with bailouts and restrictions. We trust the digital ledger because it's convenient, but convenience is rarely the same thing as safety. It's a hard pill to swallow because we want to believe the system is infallible. We want to believe that the FDIC sticker on the window is a magical force field. But deep down there's this nagging voice asking, is my money actually mine, or is it just a number they promised to let me have? My name is Jack, and I spend way too much time thinking about money, financial history, and why we've all been trained to trust institutions that, legally speaking, don't actually hold our money. And here's the thing that keeps me up at night, and it's probably going to keep you up a little bit tonight too. Once you deposit money into a standard bank account, the legal ownership of that money transfers. You are no longer the owner of that cash, you are an unsecured creditor. That means if the bank fails, you get in line with everyone else they owe money to. Now, yes, insurance exists, but we all know how slow and bureaucratic insurance claims can be. If the system really seized up, do you want to be waiting for a check in the mail, or do you want to know your wealth is secure? Today, we're going to dig into something that I call the 1955 strategy. It's a mindset and a specific set of financial moves that people understood back then but has somehow been lost in the fog of modern digital banking. It's about separating the storage of your wealth from the spending of your wealth. It's a shift in perspective that can absolutely change how you sleep at night. We're going to talk about where to put your cash so that it's not just an entry in a bank's ledger, but an asset that you actually control. It's not about being a doomsday prepper, it's about being a smart adult in a world that is increasingly unpredictable. So let's take a deep breath, grab a coffee if you need one, and let's unpack this. Okay, so let's start with the uncomfortable part. We need to destroy the illusion of the vault. You know the image I'm talking about. You've seen it in cartoons, in movies, in bank commercials. There's this giant steel door with a spinning wheel, and inside there are rows of safety deposit boxes and shelves stacked with cash. We tend to think that when we deposit our paycheck, the teller takes it, walks back to that vault, puts our specific stack of bills onto a shelf with our name on it, and locks the door. It's a nice image. It's comforting. It's also completely wrong. I remember when I first really understood this. I was probably, 22 or 23 years old. I had just started my first real job, and I felt like a big shot depositing my check. I asked the teller, a nice older lady, "So, is my money safe here?" She smiled and gave me the party line about FDIC insurance. But later, when I started reading about banking mechanics, I realized that she wasn't really telling me the whole story. She didn't mean to mislead me, it's just the story we tell ourselves. The reality is that when you hand over $100, the bank doesn't keep it. They are legally required to keep only a tiny fraction of it, like literally pennies on the dollar, in reserve. The rest? They lend it out. They lend it for mortgages, car loans, business lines of credit, credit cards. They take your money and turn it into their asset, which they use to generate interest. In exchange, they give you a promise. They give you a liability on their books. That's why, legally, you become a creditor. You've lent them your money. Now, in a normal world, this works great. It's the engine of the economy. But when things go sideways, when real estate crashes, or when loans go bad en masse, that promise starts to look a little thin. If everyone tries to take their money out at the same time, a bank run, the bank doesn't have it. They can't get it back fast enough from the people they lent it to. This is the 1955 insight. Back in the mid-50s, the memory of the Great Depression was still fresh in people's minds. A lot of adults living in 1955 had lived through the 1930s. They didn't trust the banks the way we do today. They understood that a bank is a business, not a safety deposit box. And so, they treated their cash differently. We need to get back to that mindset. We need to stop looking at our bank account as a storage locker and start seeing it for what it is, a highly convenient but risky transactional tool. It's a place to park money just long enough to pay bills. It is not a place to store wealth. That is the first and maybe most important shift we have to make. So, if the bank isn't a safe place to store your long-term wealth, where do you put it? This is where the 1955 strategy really comes into play. It's about something I call capital segregation. Think about how people used to handle money in the 1950s. They didn't have instant transfers. They didn't have Venmo. They had cash, they had checking accounts for bills, and then they had other vehicles for holding value. They often kept these things completely separate. They didn't mingle their spending money with their nest egg. Today we just dump everything into one giant pile. We have our emergency fund, our vacation savings, our grocery money, and our down payment fund all sitting in the same checking account, earning basically zero interest, fully exposed to the bank's creditors. It's like leaving your car keys, your passport, and your wallet all on the front porch. Sure, it's easy to grab them when you walk out the door, but it's also really easy for someone to take them, or for them to get blown away in a storm. The 1955 strategy says you need to build a wall between your money and the bank's gambling habits. You need to take a portion of your wealth, let's say your emergency fund or your cash savings, and move it out of the unsecured creditor zone and into a secured asset zone. Here is a personal aside. I used to be terrible at this. I would have like $5,000 in my checking account, just in case. And you know what happened? I spent it because it was there. It was easy. If I wanted a new gadget or to go out for a fancy dinner, the money was right there. I wasn't protecting it, I was slowly leaking it. When I finally moved that money into a separate, harder-to-touch vehicle, two things happened. One, I stopped spending it impulsively because there was friction involved in getting it. And two, I felt this weird sense of relief. I knew that no matter what I spent on my debit card today, that specific chunk of wealth was untouched. It was safe. It was mine. This strategy isn't about hiding money from the IRS or anything weird like that. It's about creating layers of security. It's about admitting that the banking system is a utility like electricity or the internet. It's useful, but it goes down sometimes. And when the grid goes down, you want to have your own generator. You don't want to be the one standing in the dark wondering why you didn't prepare. So, how do we actually do this? Where do we put this cash? We have a few options, ranging from extremely boring but safe, to physical and tactile. We're going to walk through the specifics because knowing why isn't enough, you need to know how. Alright, let's talk about the first and arguably most sophisticated tool in the 1955 playbook. This is going to sound a little bit nerdy, but bear with me. It's actually pretty fascinating once you get the hang of it. We're talking about Treasury Direct. Specifically, we're talking about buying Treasury bills or T-bills directly from the US government through their website. Why is this the 1955 strategy? Because back in the day, buying bonds directly from the government was a common patriotic duty and a standard savings practice. My grandfather used to buy savings bonds. He didn't go through a broker. He went to the post office or the bank and bought them directly. He held a physical certificate. That certificate wasn't a bank liability. It was a direct obligation of the United States Treasury. Today we can do the exact same thing digitally. When you open a Treasury Direct account, you are bypassing the bank entirely. You are buying a debt instrument that is backed by the full faith and credit of the US government. Now, we can have a whole separate discussion about the national debt and whether you trust the government, but generally speaking, if you have to choose between trusting your local regional bank, which might fail if the commercial real estate market crashes, and the US Treasury, which can print money to pay its debts, the Treasury is the safer bet. Here's why this is so powerful. If you hold cash in a savings account, and the bank fails, you have to file a claim with the FDIC. Creates a hassle. There's a waiting period. It's stressful. But if you hold a T-bill in your own Treasury Direct account, you don't have that counterparty risk with the bank. You own the bill. It's in your name. Let me break down how this works in simple terms. Let's say you have $10,000 you want to keep safe. You log on to Treasury Direct. It's a bit of a clunky website. Honestly, it looks like it was built in 1998, which I actually find reassuring because it means they're probably not spending your tax dollars on a fancy UI, and you buy a 4-week or a 13-week T-bill. You use the cash from your bank to buy it. Now that $10,000 is transferred out of the bank's liabilities and into your asset. It sits there. It earns interest, which right now is actually pretty decent, certainly better than a standard savings account. And when the bill matures, the government deposits the money right back into your bank account. Or you can roll it over into a new bill. It's incredibly liquid. You can get your money out in a matter of days. The beauty of this is that you are using the government's own infrastructure to protect your wealth. You are stepping out of the commercial banking loop. You're basically saying, I don't want to be a creditor to JP Morgan Chase or Bank of America, I want to be a creditor to the federal government. It's a subtle shift, but it's massive in terms of risk management. I think a lot of people get intimidated by this. They think, oh, I'm not an investor. I don't buy bonds. But this isn't high-frequency trading. It's the digital equivalent of stuffing cash under a very, very strong mattress. If you have cash savings that you don't need to touch for at least a month, there is almost no reason to keep it sitting in a standard savings account exposed to bank risk. Move it to T-bills. It's the smartest, laziest way to protect your purchasing power and your principal. Now let's move on to something more tangible. Something you can actually touch. We're talking about cash, physical cash, and safe deposit boxes. This is a controversial topic in the financial world. People love to say, don't keep cash under your mattress. It loses value to inflation. And they're right about the inflation part. But they're missing the point of the 1955 strategy. The goal isn't necessarily to get rich, the goal is to ensure you have access to value when the digital system is frozen. Imagine a scenario where there's a cyber attack on the banking grid. Or maybe the government declares a bank holiday, like they did in 1933, where banks close for a week to stop a run. Your debit card doesn't work. The ATMs are empty. How do you buy food? How do you put gas in your car? You need physical cash. But here is the kicker, where do you keep that physical cash? Keeping $10,000 in a shoebox in your closet is a fire hazard, a theft hazard, and just generally stressful. You need a safe deposit box. However, there is a massive trap here that almost nobody talks about, and this is the specific nuance that fits the nobody tells you part of this video's title. When you rent a safe deposit box at a bank, people assume it works like a locker at the gym. You put your stuff in, you keep the key, the bank can't touch it. But legally, that is often not the case. In many jurisdictions, if the bank fails, the contents of safe deposit boxes can be frozen or even seized by the state or the receivership to pay off the bank's debts. It's insane, right? You rent a box to keep your stuff safe, but if the bank goes bust, your stuff can get held hostage. So what's the solution? This brings us back to the legal concept of bailment. Bailment is a legal relationship where physical possession of an item is transferred to another party, but ownership is retained by the original owner. A dry cleaner is a bailee for your suit. A valet is a bailee for your car. If a valet crashes your car, they are liable because they don't own the car. Historically, banks were supposed to be bailees for your money in a safe deposit box. But modern banking regulations have muddied these waters significantly. This is why the 1955 strategy advises, don't use a bank safe deposit box for your most critical bug-out cash. Instead, you have two better options. One is a high-quality home safe. I'm not talking about the $50 fireproof box you buy at Walmart. I'm talking about a real, heavy, bolted-down safe that weighs as much as a refrigerator. It's a hassle, yes. You have to find a place for it and you have to anchor it. But if the banks are closed, your home safe is accessible. The other option, and this is one that fewer people know about, is using a private vault service. These are non-bank facilities that specialize specifically in storing precious metals and cash. Their entire business model is based on bailment. They don't lend out your assets. They don't leverage them. They simply store them. Because they aren't banks, they aren't subject to the same bank holiday rules. If the financial system melts down, these private vaults might actually be the only place where you can go to retrieve your physical wealth. I know. It sounds like a movie plot. It sounds like you're preparing for a zombie apocalypse. But look, you buy car insurance, right? You have health insurance? This is just wealth insurance. It's boring until you need it, and then it's the most important thing in the world. Let's take a step back and talk about the human side of this. Because honestly, all of this strategy means nothing if you can't stick to it. One of the biggest reasons we keep too much money in the bank is convenience. It's easy. It's frictionless. I want a pizza, I tap my phone. I need to pay rent, I set up autopay. The 1955 strategy introduces something that modern humans hate, friction. Moving money to Treasury Direct takes a few days. Going to a private vault or even dealing with a heavy home safe is annoying. It takes effort. But in finance, as in life, things that are easy are often dangerous, and things that are hard are often valuable. There is a psychological concept called pain of paying. When we use physical cash, we feel a pain in our brain when we hand over the money. That's why it's harder to spend cash than it is to swipe a card. By introducing friction into how we access our long-term savings, we are actually hacking our own psychology to protect our wealth. I've noticed this in my own life. When I have too much liquidity, too much money readily available in my checking account, I tend to rationalize purchases. Oh, I work hard, I deserve this new watch. Or, yeah, let's upgrade the flight to first class. It's just noise. But when my wealth is tied up in a T-bill or sitting in a safe deposit box, or a home safe, I have to really want something to go through the trouble of getting the money. That pause, that 24-hour cooling off period, saves me thousands of dollars a year. It turns the 1955 strategy from just a security tactic into a budgeting tactic. It kills impulse buying. It forces you to be intentional. Think about it this way: the banks have spent billions of dollars designing their apps and their credit cards to remove friction. They want you to spend. They make money when you spend. So, by reintroducing friction into your financial life, you are effectively swimming upstream against a current designed to make you poor. It's tiring, but it gets you to a place that nobody else is going to. I know a guy, let's call him Dave. Dave is a wealthy guy, not by a yacht wealthy, but set for life wealthy. He told me once that he never keeps more than $2,000 in his checking account. Everything else is swept out immediately into accounts that take 3 to 5 days to access. He said, "Jack, if I can't afford to wait 3 days for the money, I can't afford the purchase." That simple rule changed his life. It's stuck with me ever since. That is the essence of the 1955 strategy. It's about slowing down to speed up. Now, I know some of you are watching this and thinking, okay, Jack, this sounds great, but I'm not ready to buy T-bills and I don't have room for a safe in my apartment. What about credit unions? Aren't they safer? This is a great question. It's a very common pushback. And the short answer is, yes, they are generally safer, but they are not immune to the same problems as big banks. Credit unions are not-for-profit organizations owned by their members. Because of this, they tend to be more conservative with their lending. They didn't get involved in the subprime mortgage mess in 2008 the way the big banks did. They are usually deeply embedded in the local community. I love credit unions. I genuinely do. I think they are a better place to park your transactional money, the money you use to pay bills, than a massive, global bank like Wells Fargo or Citibank. However, we have to be real about the limitations. Credit unions are still part of the fractional reserve system. They still lend out your deposits. And while they have deposit insurance, usually through the NCUA instead of the FDIC, but it works basically the same, the payout process is still a bureaucratic nightmare if the institution fails. Also, credit unions often have fewer digital redundancies. If the big banks go down, the credit unions might actually be more vulnerable to IT outages because they don't have the massive IT budgets that the megabanks have. So, my advice on credit unions? Use them. Love them. But don't rely on them as your only layer of defense. Move your checking account to a credit union to support a local business and avoid the fees of the big guys, but still apply the 1955 strategy to your savings. Take the bulk of your wealth out of the credit union and put it into T-bills or a private vault. Diversification isn't just about owning different stocks, it's about diversifying the custodians of your wealth. Don't put all your trust in one institution, no matter how friendly the tellers are. At the end of the day, they are still subject to the same laws of physics and economics that govern the big banks. We can't have a conversation about holding cash without addressing the big, scary elephant in the room, inflation. I can hear the comments section now. Jack, you idiot. Cash loses value every year because of inflation. If you stash cash in a safe like it's 1955, you're losing purchasing power. And look, you're not wrong. Inflation is the silent killer of wealth. It's the reason why a gallon of milk used to cost $1 and now costs $4. If you bury $10,000 in a coffee can in the backyard for 20 years, when you dig it up, it won't buy as much as it would have today. But here is the nuance that people miss. The 1955 strategy isn't about investing for growth. It's about preserving liquidity for survival. I have a rule of thumb. My money is divided into 3 buckets. Bucket 1 is risk on. This is my stock market portfolio, my real estate, my business investments. This money is exposed to the market, but it has the potential for high returns to beat inflation. Bucket 2 is stability. This is my treasury bills, my bonds, my life insurance cash value. This money earns a steady rate, beats inflation slightly, and is very safe. Bucket 3 is survival. This is the cash in my safe. This is the get in the car and leave money. For bucket 3, I don't care if inflation eats 2% or 3% of it a year. Why? Because if the event happens that requires me to open bucket 3, a bank collapse, a grid down scenario, a personal emergency where cards don't work, the value of that cash is going to skyrocket in real-time terms. In a deflationary crash, cash is king. In a chaotic situation, having a physical asset that people accept universally is worth a hell of a lot more than a digital number in a brokerage account that you can't access. Think of it like a fire extinguisher. You have a fire extinguisher in your kitchen. It costs money. It sits there gathering dust. It doesn't appreciate in value. In fact, it expires and you have to replace it. It's a losing investment financially. But if your toaster catches fire, that fire extinguisher is suddenly the most valuable item in your house. Cash in a safe or even in a T-bill account that you can access quickly is your financial fire extinguisher. Don't worry about optimizing its ROI. Worry about its reliability. Alright, let's get practical. I want you to actually be able to do something with this information, not just think deep thoughts. Here is your 1955 strategy blueprint. If you do these 3 things in the next month, you will be more financially secure than 99% of the population. Step 1. Audit your accounts. Log into your banking app. Look at your balances. Be honest with yourself. How much of that money do you actually need to pay bills and buy groceries in the next 30 days? That is your operational cash. Everything else is wealth. Most people keep 3, 4, 6 months of expenses just sitting in their checking account. That is dangerous and inefficient. Identify the excess. Step 2. Open the Treasury Direct account. Go to treasurydirect.gov. It's a government site. Create an account. It's going to ask for your info, your bank details for funding, all that jazz. Yes, it's a bit of a pain. Do it anyway. Once you're set up, take a portion of that wealth, money. You don't have to do it all at once. Maybe start with $1,000 or $5,000 and buy a 4-week Treasury bill. Watch the process. See how it works. Get comfortable with the idea that your money is now working for you as a direct creditor of the government, not as a liability of a bank. Step 3. The bug out box. Go to the store. Buy a small fireproof box. Or if you're serious, research and buy a proper heavy safe. Put $500 or $1,000 in cash in it. Maybe put some silver coins in there too if you're into that. Put it in a secure spot in your home. Not under the bed. Be creative. And then forget about it. That money is not for pizza. It's not for a new video game. It is there so that if the world goes weird for a few weeks, you don't panic. It gives you options. It gives you time. That's it. 3 steps. It's not rocket science. It's just about taking control. It's about acting like a responsible adult from 1955 who remembers that the world can be uncertain. I want to wrap up this section by talking about the peace of mind dividend. When I first started moving my money out of standard checking accounts and into treasuries and a bit of physical cash, I was surprised by how I felt. I thought I would feel anxious, like I was doing something wrong or hiding something. But I didn't. I felt light. I realized that a lot of my background anxiety, the low-level hum of stress that I carried around all day, was actually related to money. Not because I didn't have enough, but because I felt insecure about where it was. I felt like my wealth was sitting on a house of cards that I couldn't control. By implementing the 1955 strategy, I took back control. I removed the counterparty risk. I removed the reliance on a system that I don't trust. And that feeling of autonomy? You can't put a price on that. It's like the difference between renting an apartment and owning a home. When you rent, you're always wondering if the landlord is going to sell the building or raise the rent. When you own, sure, you have to fix the toilet yourself, but nobody can kick you out. You stand on your own ground. That is what this is about. Standing on your own financial ground. It's a quiet confidence. You walk down the street, you hear news about bank stocks crashing or interest rates spiking, or whatever the crisis of the week is, and you just shrug. You know you're okay. You've got your fire extinguisher. You've got your direct treasury obligation. You've got your cash box. You're part of the system because you have to be, but you're not of the system. You're your own lifeboat. So here we are. We've gone from the panic of a 2 a.m. worry session to a concrete plan for financial resilience. We talked about how the bank isn't a vault, it's a lender. We talked about how the 1955 strategy is about separating your spending money from your storing money. We covered Treasury Direct accounts, private vaults, the psychology of friction, and the importance of having a physical emergency stash. The main takeaway here, the one thing I really hope you remember, is that the financial landscape has changed. The rules of your parents and grandparents, they got watered down. We were seduced by convenience. We traded security for the ability to buy a latte with a tap of a phone. But you can opt out of that trade. You can have convenience for your small spending money, but you can demand security for your life savings. Look, I don't know what the future holds. Nobody does. Maybe the banks will be fine for another 50 years. Maybe I'm being overly cautious. But let me ask you this, if I'm right and the system hiccups, who is going to be sleeping better? The person who has all their eggs in the bank basket, or the person who took a few afternoons to set up a Treasury Direct account and buy a fireproof box? It's a small effort for a massive amount of insurance. It's about treating your money with the respect it deserves. It's about acknowledging that you worked hard for that cash, and you shouldn't let it become an unsecured liability in someone else's ledger. So, my challenge to you is this: don't just watch this video and nod along. Go do the audit. Open the account. Buy the safe. Even if you start small, start today. Take one step toward reclaiming the financial independence that people in 1955 took for granted. You've got this. It's your money. Keep it that way. Thanks for hanging out with me, and I'll see you in the next one.